The Federal Reserve just panicked, $42 billion, injected, overnight. And the mainstream media is burying this story. For years, precious metals investors have been mocked, dismissed, told they were living in the past. But today, the Fed's own data exposes the fractures they tried to hide. The cracks are forming. The pressure is building. The silver shorts are trapped in a position they cannot escape. In the next 8 minutes, I'm going to show you exactly what the Fed just did, why this is a sign of desperation, not strength, how this connects directly to the silver market, and what this means for everyone holding physical metal. By the end of this video, you will understand what 99% of investors will never figure out until it is too late. I am with MoneyMind Hub Pro. I do one thing here, cut through the noise and show you what the financial establishment does not want you to see. You will find value in this. So hit that subscribe button and the notification bell right now, because what comes next will be even bigger. Now let me show you the smoking gun. The Federal Reserve just pumped $42 billion into the overnight repo market. This is not my opinion. This is not speculation. This is their own data, published on the New York Federal Reserve website for anyone willing to look. When the Fed injects liquidity at this scale, it means one thing and one thing only. Someone in the system needed cash immediately, and they needed it desperately. The repo market is the emergency room of the financial system. It is where banks go when they are bleeding out. And right now, the patient is flatlining on the table. We saw this exact pattern in September 2019 when repo rates exploded to 10% overnight, forcing the Fed to intervene with hundreds of billions in emergency liquidity. That was the warning shot. This is the escalation. The Fed will call this routine. Technical adjustments. Nothing to see here. But the pattern screams a warning. These injections are increasing in size, increasing in frequency, increasing in desperation. And that pattern has historically preceded every major market dislocation of the last 2 decades. This is not coincidence. This is cause and effect. Now connect the dots with me. The silver market operates on a fractional reserve system that would terrify most investors if they truly understood it. For every single ounce of physical silver that exists in deliverable form, there are dozens of paper claims trading against it. This is not theory. This is market structure. This is how the game has been rigged for decades. Short positions in silver, bets that the price will fall, have reached historically extreme levels. Here's the trap, and there is no escape. When liquidity tightens across the financial system, institutions scramble for cash. They reduce leverage, they cover positions, and when short sellers cover, they must buy. In a market where paper claims vastly outnumber physical supply, this creates a mathematical impossibility. If a meaningful percentage of shorts try to cover at the same time, there's simply not enough physical silver on the planet to satisfy delivery. The shorts have not collapsed yet, but the conditions that will destroy them are building like pressure inside a volcano. The eruption is not a question of if, it is a question of when. History already gave us a preview. In early 2021, silver exploded from $25 to nearly $30 in a matter of days when retail investors identified the vulnerability in short positions. The shorts barely survived. They limped away wounded, bleeding, exposed. But the physical market told the real truth. Dealers were charging premiums of $5, $8, even $10 over spot price because actual metal had vanished from shelves. The paper price said one thing, the physical reality said another. That gap between paper and physical is the gap between illusion and truth. Now consider what happens when the next wave of buying pressure hits during a genuine liquidity crisis, when banks are already desperate for cash, when the Fed is already throwing billions at a system that refuses to stabilize, when institutions start hoarding instead of lending. The pressure compounds, the exits narrow, the trap closes, and those holding physical metal will watch from the sidelines while the paper castle burns. This is why smart money is watching Fed liquidity operations obsessively. It is not about one injection. It is not about one data point. It is about the pattern, the undeniable pattern, the unmistakable pattern. The financial system requires ever-increasing intervention just to maintain the illusion of stability. Every injection is an admission. Every intervention is a confession. Every billion pumped into the system is proof that the underlying disease has not been cured. It has been masked. For everyone who has been stacking physical silver, who has endured years of sideways price action while others mocked your conviction, who has stayed the course while the mainstream called you paranoid, these developments represent vindication. Not a guarantee, but a signal. A loud signal. A signal that grows louder with every Fed intervention. The fundamentals that made silver attractive have not weakened. They have intensified beyond imagination. Industrial demand is accelerating. Electric vehicles need silver. Solar panels need silver. Electronics need silver. Meanwhile, mining supply is constrained. New discoveries are rare. Production costs are rising. And monetary instability is spreading across every major economy on Earth. Every Fed intervention confirms that this system cannot function without life support. Every increase in short positions is a bet that the support will continue forever. History shows us exactly how those bets end. They end in collapse. The timing is unknown, but the direction is crystal clear. So what do you do with this information? First, physical beats paper, period. No exceptions, no debate. If you hold silver in ETFs or unallocated accounts, you hold a promise, and promises break. In a real crisis, paper claims evaporate like morning fog while physical metal remains solid in your hands. Second, verify everything I just told you. The Fed's repo data is public. Go to the New York Federal Reserve's website. Track the injections yourself. See the pattern with your own eyes. Do not trust me. Trust the data. Third, stay patient, stay disciplined, stay ruthless. Markets can remain irrational longer than anyone expects. The pressure on silver shorts will build for months, perhaps years, before resolution. But every single day that pressure builds, the eventual release becomes more explosive, more violent, more rewarding for those who held the line. I give you data, you make the decision. I'm not here to tell you what silver will hit by what date. Anyone claiming that certainty is either lying or delusional. I'm here to show you the map, you choose the path, you take the action, you accept the responsibility. This opened your eyes. Now send this video to one person who is still asleep. Drop a comment below and tell me, do you think the Fed can keep the system on life support forever, or are we watching the beginning of the end? Subscribe to stay ahead of these developments. Ring that notification bell so you never miss an update. Watch the video appearing on your screen right now for my deep dive into silver supply constraints and why the physical market is tighter than anyone in the mainstream is willing to admit. This is Money Mind Hub Pro. The window is closing. The clock is ticking. The opportunity is narrowing. Stay informed, stay prepared, stay strong. And I will see you on the other side. This video is for education and entertainment only. This is not financial advice. I'm not a licensed financial advisor. Markets and precious metals involve high risk, and you can lose money. Do your own research and consult a professional before investing. You're responsible for your own decisions.